This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 10th. Some highlights from today's show. Trump tariff news escalates. What is driving the price of gold? And let's review the economic data calendar. Good day traders then, and welcome to another action-packed week ahead of us. Let's get stuck straight into it and talk about some of the overnight news. Of course, we did have the Sunday night gaps again. This was a result of Trump's announcements from Air Force One. We'll get into those in a moment. The point is, though, however, coming into today, the bond markets are all absolutely flat like a pancake. The currencies, by and large, are also relatively flat, with the yen down 0.5%. And the equity markets have pretty much not just retraced the entire gap, but are actually looking to open up around 0.5%. Now, what is interesting, of course, is that we can see the European equities, the ones that have been sort of leading for the last 4 or 5 weeks, they're somewhat underperforming today, and we'll talk a little bit about why that's the case. But I think it's got everything to do, of course, with what Trump is going to inform us about come Tuesday, Wednesday this week. So the key takeaway is, of course, the European equities are a little bit more nervous than, of course, the US counterparts, and I think that's got everything to do with those tariffs. Now, let's talk about our first topic today, and it is, of course, all about the Trump tariffs. Now, what did he tell us? Well, he did tell us that he's going to impose 25% tariffs on steel and aluminium, and it's going to come into effect immediately. Now, the markets did stage a little bit of nervousness on this, and I think this was perhaps a little bit misunderstood in a sense of, yes, fine, it was kind of out of the blue. However, he did this in his first term. He came out effectively and he put tariffs on steel and aluminium in his first term, and eventually what he did was he pretty much let everyone off the hook. So Mexico and Canada were exempt from that, and then when Biden came into presidency, he pretty much let the European Union off, as well as Great Britain and a few other countries. So the point is that fine, he did impose these tariffs, but the way the market's looking at it is it's not going to have a significant impact. Rather, it's going to be very targeted. Okay, so he's going to impose these tariffs on countries where there's no real benefit to the United States, and so having those tariffs in place is only beneficial for the US. So that's why the market is kind of reversed. It's very much just a case of it's not really an impact on the US economy. Now, what could, of course, be impactful is what comes next. Trump has thrown us a bone on Friday talking about reciprocal tariffs. And I think the way to look at this is a form of counter tariff. So the way I think the market's starting to interpret this is the US is pretty much going to impose tariffs on countries that impose tariffs on them. So, for example, and I think the prime candidate here is the European Union. On cars, the European Union imposes a 10% tariff. And so what Trump is saying was, well, look, we currently charge 2.5% on cars, so we're just going to match you. So there we go. European Union, we're going to hit you with 10% tariff on cars and the like. So that's kind of what it's going to be. It's going to be a tit for tat. It's going to be a country by country basis. And it's pretty much going to be across the board. Now, I think the key thing to keep in mind, of course, is that there's multiple moving parts here. Of course, we're going to find out about these reciprocal trade tariffs tomorrow/Wednesday. Now, it's not to say we won't get more information about it over the course of today. That's very, very possible. But, of course, we do know that Mexico and Canada have been let off the hook for now, effectively until the 1st of March. Now, a few key takeaways. This is effectively the quota questions in terms of his first presidency. So, like I said, you can go read through that in your own time. But what I want to kind of point out is effectively Trump has been complaining for a long time about European auto import tariffs. And hence that's why the euro is underperforming, and why in particular, like I said, the European equity indices are underperforming. They're very much expecting now that there is a tariff coming into play as soon as Tuesday, Wednesday this week. Now, just a few interesting statistics to note. Of course, Canada accounts for 79% of all aluminium imports into the United States, hence why it looks as though this aluminium and tariff imports is very much going to be targeted. The likes of Canada and Mexico, of course, they will be exempt from this because of how significant they are to the US economy in terms of aluminium and steel imports. Okay, so that just showcases why the market has shrugged it off. It's very much a case of it will have a limited impact when we work out, the total dollar amount that is actually going to be available for tariffs. Okay. Now, I think the key takeaway to all of this, okay, where am I going with this? Well, look, it's Monday today. These are very, very much news flow driven markets. The markets are not moving at all. They haven't been moving effectively for the last 3, 4, 5 sessions. Why? Well, because everyone's just sitting on the sidelines waiting for more clarity. Okay, this is very, very typical when the markets go into these news flow cycles. Unfortunately, day trading becomes a little bit dull, but at the same time exciting in that you can sit there for 4 days of the week, do absolutely bugger all, and then all of a sudden on one day the comments come out and the market just opens up and becomes volatile. Okay, the key thing to take away is the sooner we get back, or the sooner we get some form of certainty on what exactly is going to happen with tariffs, the sooner the markets will start to trade a little bit more technically, a little bit more point to point. Okay, for now, they are flow driven markets. They're going to be driven by the news flow and the news cycle, and we just have to be switched on for that. Okay, what does that mean for day traders? Well, you definitely don't want to be hanging on to positions for too long. You definitely don't want to be holding too many overnight trades either. It's very much day to day, try and flatten out at the end of the day, each day, and come in just looking for that opportunity scope based on the news flow. Okay. Now, with that in mind, what are we watching out for? What do we want to listen out for with regards to Trump today, tomorrow, Wednesday? Well, what we do know is that Trump came into his presidency talking about a universal tariff, okay, which is somewhere between 10 to 20%. Now, this doesn't mean he's going to say, everybody, we're hitting you 20%. It's very much going to be targeted. It's going to be tit for tat. It's going to be coordinated. It's going to be, hey, Europe, your auto sector, we're hitting with 10%. Hey, Vietnam, we're going to hit you with 15% on this. Hey, India, we're going to hit you with, 10% on that. So it's going to be very much a tit for tat reciprocal type trade war. So again, what does that mean? Well, it means there's going to be a lot of interpretation. That's not always good for us as traders because, like I said, you could read something and at face value it could seem like it's an escalation, but when the smart money goes and actually does the calculations and works out the total amount of imports that are actually going to be impacted and what the dollar value of it is, it may actually be a damn squib and absolutely nothing. Okay, so you've got to be very, very careful, and I think point in mind is exactly what we saw at the open yesterday. The market shrugged it off almost instantly. Why? Because the smart money knew that it's not going to be that impactful in terms of total dollars. Okay, so that's how you have to look at this. It's very much nuanced. It's very much devil's in the detail, and it's very much about the percentages that get imposed. Now, what we do know is that Trump has taken a more sort of conservative approach where he'll put some tariffs in place and rather say, look, come to the negotiating table, let's talk, and if they don't talk, then he'll escalate. Okay, so it's very unlikely Trump's going to come out, bullets and going too aggressively initially, because that's not his objective. Okay, his objective is he wants to get concessions, and to do that he needs to fire the first shot, which is what we should get later on this week. Okay. Now, let's turn our attention and move across to the Mag 7. We are very focused on them. Why? Well, because they're completely underperforming now. This is the third week in a row. If we have a look at last week, in essence, we can see, Microsoft down 1.5, Apple down 3.5, Tesla down 10.5, Alphabet down 9, Amazon down 4. We spoke about that. All the leadership is gone in the Mag 7. The only one standing is Meta. Okay, that's the only one that now, if you go and have a look at all these charts and their 200-day moving averages, Meta's the only one that's significantly trending higher. They are sitting, of course, at record highs. Nvidia, we've spoken about that for the last 2-3 weeks. That seems to have now topped. We'll get to that chart in a moment. But I think the key takeaway is there's just one man standing in the Mag 7, and the leadership is not going to come from the Mag 7. Okay, now why does that matter? Well, because it's a risk to the markets. Very clearly right now the market's not concerned about that risk, because otherwise the VIX would be quite a lot higher. But right now we cannot rely on the Mag 7 to drive this next phase into record high territory. It's going to have to come from something else, and I suspect that something else is the form of US growth. And I think that's going to be the key story for Q1. It's going to be all about, do we get the Trump bump, let's call it, where we get a real pickup in growth as a result of the excitement around his policies, or do we get the opposite? Do we get a little bit of a growth scare? Now, if we get that growth scare, we know that equities are very sensitive to growth. If we don't have Mag 7 supporting it, what it does mean is that the down move this time around is going to be far more aggressive, far more quicker. Why? Because no one's providing liquidity in the same way that they would typically when the Mag 7 was leading the charge to the upside. Okay. With that in mind, let's talk a little bit about NVIDIA, because we did close above that key area, that 127 to 129. We have had 5 days of one-time framing. So NVIDIA is looking strong at face value. Okay, if this was a sort of a chart, and I was very interested in this, I'd say today's a very important day for NVIDIA. We closed back above that 129 again. I think that would start to open up the door to a bigger rally in NVIDIA, but it begs to be seen. Okay, I think there's a lot that can happen between now and the end of today's session, so I'd very closely be watching NVIDIA. We closed back below that 129. You can initiate those shorts all the way back down to that weekly low around the 112. Okay, I do suspect this gap will stay and remain for some time longer until we actually fully understand what is going on in the world of AI, and in particular what's going on with regards to capex for not this year but next year. Okay. Let's turn our attention then and talk about the US bonds. I think it's an interesting one to keep a close eye on, simply because this week we have got a number of key data points out. We've got, of course, Jerome Powell for his testimony out tomorrow, and that's always very closely watched. Will he give us a little bit of a signaling, a little bit of a clue as to about what he thinks of the most recent non-farms that we had on Friday, or will he tell us nothing? Will it be sort of same as usual? We still remain confident, and everything is looking hunky-dory. That's ultimately what the market's going to want to listen in for very closely tomorrow. And then Wednesday, we've got a very, very important data point in the form of US CPI. Now, why does it matter? Well, you can see if I point out this day over here, this big down day, and over here, big down day, that was effectively the January CPI. Now, if you cast your mind back, it pretty much came bang on in line. Everything was in line except the core missed by 0.1. And we effectively, if you think of the 10-year dropped 40 basis points from that point. Okay, so the bond markets really, really like that. The same time, of course, the curve flattened quite a lot. Okay, so the market took that as a very, very positive spin. Why? Well, because inflation's coming back to target a little bit quicker. The Fed can cut and ultimately support that growth trajectory into the future. Okay, the market's going to play just as much close attention to the CPI this week. Of course, we had some very interesting data out of the non-farms on Friday, as well as the University of Michigan inflation expectations are now hotting up quite extensively. So the question is, will that start to filter through into the headline CPI number? If it does, well, we can pretty much find our way all the way back up towards that 480 in pretty short order. And that's going to have implications for a number of markets, including equities, as well as, of course, the gold market. Now, with that in mind, let's talk a little bit about gold. Before I forget, in terms of the week ahead, the two key data points are, of course, inflation, as well as Fed's Jerome Powell. But then we do have Tiger Woods and Donald Trump playing golf this week, which is quite a fun one to keep a close eye on. But jokes aside, talking a little bit about gold, we have now reached very, very overbought territory. So what is going on in gold? Well, if you type into a ChatGPT what's going on in gold, it's going to tell you all the usual rubbish, which is, there's concerns of tariffs, therefore risk off is one of the key drivers. Now, I'll push back against that, because if that was true, bonds would be a lot further up the page, yet they're not. I think the drivers of gold, there's two at this point in time. I think one of the primary ones is, of course, inflation expectations are still very, very elevated. And we can see that we do have a bit of a stubborn central bank in the Fed that's telling us, look, we're going to look through it. We're happy to accept this higher level of inflation. I think that's one key proponent of it. I think as a result, people do want to be hedging against this idea of, sort of 3.5–4% inflation. Don't forget the wage growth out of the US came out at 4.1% on Friday. Now, that does not align with the 2%